Afternoon. My name's Mike. I'm sorry that I'm not there able to be with you guys tonight, or that I missed and also that I missed last week as well. I've got a lot of work conflicts that are going to wrap up here in the next week or so, and I'll be a more full participant. I did want to talk to you a little bit. I know that last week we talked about Chapter 1, and there was some discussion about the Tax Act that was passed last fall, and I think the book doesn't incorporate a lot of the changes that the tax bill made, but that's okay because the concepts that the book teaches are a lot of the base concepts that you need to understand to be a tax practitioner or to do tax returns. And the bill that was passed added some very specific provisions that are nice and add some simplification and reduce rates and give some new deductions to us. And that's not covered in the book, and I'll bring those up as we go along, and I'll highlight the things that have changed. But the concepts that the book teaches and that this course is going to cover are going to be relevant, they're going to be valuable, and they're going to be applicable, despite the fact that the book doesn't take into account some of the changes from the bill. And I'll point out as well, I don't know if you will be able to attend, but Thursday at 2:30 and at 4:15, I'm going to be doing a presentation at the Longmont Chamber of Commerce, their peak event, which is a business expo at the Plaza Hotel and Convention Center. And I'm going to talk about, for about 30 minutes, I'm going to do a session and talk about how the tax bill impacts small business owners and what they can do with the bill to reduce their own taxes. So if you're able to hit that, that'd be great. If not, don't worry about it. We'll talk about those things in this class in particular as well, and we'll kind of cover some of those. But I did want, one of the things I wanted to mention in relation to Chapter 1 is the concept of income. And when Congress drafted the code and Section 61 in particular that defines gross income, they use very broad and very inclusive language. And gross income for income tax purposes is defined to mean income from any source derived. And so if you're enriched, if you are economically better off as a result of a transaction or an event that happened, then that's very likely income, and it's going to be taxable. And income is taxable if you earn it, and it's taxable in the year that you earn it. And then we'll get into accounting methods and things like that, and I think maybe Chapter 4 or 5 will talk about cash basis versus accrual basis, and that deals with the timing of recognition. But whether you earn it or not or whether you are enriched or not is the test for did you have income. And a lot of times I get asked the question from clients or affiliate or associates, and they're asking, is this income? Mike, is this income? This is what happened. Is this income to me? And more often than not, the answer is yes. And income is included and it's taxed when you earn it. And deductions are a matter of, there's a phrase called legislative grace. So deductions have to be specifically allowed. And there's a litany, a long list of things that are deductible. And the difference between income and deductions in the definitional sense of how the code is drafted, income is included when you earn it. And there's no list of things that make up income. So income is very broad, very inclusive, and deductions are very limited and very exclusive. So if you are economically better off, you've had income, and if, despite the fact you may have spent some money on something, it may not be deductible if it doesn't meet one of the listed items to be deductible. And one of the things that the tax bill did that has upset a few people is they legislated away a handful of deductions. And for example, we always have taken a deduction for our children. And if you had a child, you had an exemption, and you had an exemption for yourself, and those were worth about $4,000 a piece. And to most folks, that was worth about $1,000 in tax. And one of the biggest changes that the bill made was to do away with the deduction for a personal exemption. And so no longer does it matter. It does kind of, but no longer do you get a deduction because you had another child during the year. And the old joke was, if you were pregnant in the fall of the year, you always wanted your child to be born before New Year's Eve, because that got you one more year of the child deduction. And so, but no longer does that matter. Although It does because there is a credit. So we've always had a child tax credit, and when they did away with the deduction to try to balance that out for families, they increased the amount of the credit. And so we still need to understand what exemptions are, and we still need to understand what the definition of a dependent is, but the way it's used in the return is now a little more limited than it ever was before. And then another thing they did, they legislated away the miscellaneous itemized deductions. And so things like tax preparation fees and union dues and investment expenses, and that may be the most significant one, is investment expenses. But these things were in a class called miscellaneous itemized deductions, and they had a limitation on them. You had to exceed 2% of your adjusted gross income before you had any net deduction, and we'll go through some of how those things work in later chapters as well. And so a lot of people didn't take this deduction in the grand scheme of things. They put it on the return, but when you did the math, you didn't get any net benefit from it. And so that change doesn't necessarily affect a lot of taxpayers. The dependency exemption affects almost everybody, but the change in miscellaneous itemized deductions doesn't affect that many people. It does, however, affect people and trusts in particular that had a lot of investments and paid significant amount of investment fees, because those deductions, those broker expenses, those commissions, and those investment management fees that used to be deductible as a miscellaneous itemized deduction, now they're not. And so that's going to be a problem for some people. What else did they do? Some of the other things they did in the bill were to reduce the tax rates, and that's going to affect almost everybody. Well, it will affect everybody because the tax rate brackets were adjusted downward across the board. Let's see. The other things that I wanted to make sure we hit on, some of the things, my goal for this class, other than just to be a resource for Colleen and to be a technical resource for you guys, is I want you to understand how to put together a 1040. And I don't know what your career goals are, but everybody has to do a 1040. We all have to do one for ourselves. And if your family finds out you've had a tax class, they'll ask you to do theirs. And I want you to understand kind of what it takes to do a 1040. And I'm going to bring in some examples from my work. I'm going to bring in some client examples. I'll sanitize names and stuff, but I want to use some real world stuff and set up a case study to have you guys go through and do a 1040 from scratch with the kind of information that my clients typically bring me, so you understand how to get from your source documents and then take those documents and create a work paper file and then get those numbers on the return and understand what forms and schedules you need to use and how to put it all together. So hopefully that'll go okay and we can get that done. And I'm happy to help and take questions and answer questions and work with you guys through the semester. Again, I'm sorry that I'm not there, and I'm going to try to keep this from being too long and unwieldy, but I did want to say hi and introduce myself. I guess just to give you a little background about me, I've been a CPA since 1991. I worked in large national firms early in my career. I've worked in small local firms for a long time, and I was a controller and a tax director for a company in Boulder for 8 or 9 years, and now I've got my own firm. So our company I was in Boulder with got bought out, and long story short was that my job went from being very engaging and very enjoyable to not that much fun at all, and I decided to do something different. And I realized that early in my career, when I was working with small, closely held companies and family-owned businesses, that we did a lot of traditional services and we did a lot of one-off services that we were asked to do, and our clients appreciated it. They really appreciated what we did, and they seemed to care about what we did, and I thought that was enjoyable for me, and so I'm trying to replicate that environment in my firm now. My office is downtown Longmont. I've got an intern that came from Front Range last fall, came out of this class, that's going to work with me through tax season this year, and so we're growing and having fun and taking care of people, and hopefully in a few years I can hire a couple more people and see what this can do for us. So anyway, I'm looking forward to working with you guys this semester. I'm sorry again that I'm not there. I've got a client in North Carolina, a large corporate client that went through a merger and had a few hundred state and local tax returns to get done, and the deadline's October 15th. We're about done. We're going to get it, and I'll be back in Longmont full time, and for the rest of the semester I don't expect to miss any more classes. So hopefully that'll work out, and I'll spend some time with you guys, and we'll have some fun, and we'll learn some things, and we'll accomplish a few things. So thanks, have a great evening, and my email. My email is on the syllabus. If you have any questions, you feel free to email me, or you can call that number as well, and that's my office number, and we'll be glad to talk to you and make an appointment if you want to come by my office, and we'll go from there. Thanks, guys.